please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, let's get straight onto the earnings corner then. Telecom major Bharti Airtel posted a mixed set of earnings yesterday. The domestic business disappoints while the Africa business came in a surprise. Ronit is here with all the details. Ronit, good morning. Over to you.
Good morning, Anisha. So as you said, the domestic business disappointed, but the African business, that's where the big surprise came in. I'll start with the consolidated revenues. They were down 7%, largely below our estimates, came in around 20,300 crores, whereas the EBITDA, that came in down by 4%, which met our estimates. But the margins, that's where the beat came in around 37.3% versus our estimates of 36.1%, and the PAT, that was much higher than estimates. But if you move on to the India wireless business, that's where the pain point is. Revenue was down 12%, largely led by the interconnect usage charges that were cut by around 57% in September of this year. That impacted revenues. Moving on to the EBITDA, largely EBITDA was down by 17%, again below estimates, largely led by unlimited plans that have been launched to gain more customers. And finally, the margins, they came in around 200 basis points lower. But the sweet spot was the African business. The revenues was down only by 1%, but the EBITDA that came in up by around 8%, largely led by network efficiencies as well as the margins at the highest ever at 35.5%. As you know, African business last year was a loss making at the EBITDA level. This time it came out of the EBITDA profit of around 1,800 crores. Now moving on to the average revenue per user, that was a slight disappointment, coming in at 123 versus 145 quarter on quarter. And if you move on to the key performance indicators, the customer base was up by around 2.9% at 29 crores quarter on quarter. And if you see the data usage, that's up by 41%. But the one big thing was the data usage per customer. Last year, the data usage per customer was around 900 MB. This year, it came at 5,000 MB. That's a jump of almost 5.5x. Back to you.
Okay, all right. Thanks so much for that, Ronit. But FMCG major ITC will be on the radar on the back of its third quarter earnings that are expected later today. Now, the street expects weakness to continue as GST is expected to hurt the cigarette volumes. Mangalam's with us to run us through a quick preview. Mangalam.
That's right, Nigel. Classic miles as far as ITC's third quarter numbers are concerned. Remember, weakness on account of the GST rate hikes that came by during the year will hurt the volumes. But as it happens in the third quarter every year, is the fact that the street keeps one eye on the results, but the other dominant eye is always on regulatory changes, because this is also the time which is closer to the budget. And yesterday we had the GST Council meet, so we are watching out for the regulatory changes in terms of taxes. Just as far as the numbers are concerned, we're watching out for a revenue growth of 9.1%. Remember, this is excise adjusted revenue. So in the base quarter, we have taken the excise component off to make the comparison. So 10,086 crores is what we're working with in terms of a top line, though the absolute numbers may look very, very different. So watch out for the EBITDA then. We're working with a number of 3,900 crores, which is a 10% increase, and that primarily comes by on the back of the price increase that the company has taken. 38.7% is the margins that we're working with, and 7.5% improvement on the net profit. Now, cigarette volumes, the company does not explicitly mention them, but we're expecting the cigarette volumes to be hurt by about 3%. A 3% decline is what we're working with, and that is primarily because, remember, the previous quarter too, we saw a 7% decline in the cigarette volume, and this weakness will continue post the GST regime. There are expectations for the FMCG business, 12 to 15% growth there. 10 to 11% growth in the hotels business as well. So let's see what happens. But the most important mainstay is cigarettes. 90% of the operating profits comes from there.
All right, Mangalam, thanks so much for that. But let's shift focus to the IT space then. HCL Tech, that's going to be in the focus on the back of its quarter three numbers. Anisha, what are you expecting there?
Well, Nigel, the expectation is that this one will outperform the industry. We have seen the constant currency growth of 0.8 to 1% for the likes of Infosys, TCS. Here we are working with a constant currency growth of around 2.5%. Remember, of course, there's the organic as well as the inorganic part to it. But other than that, in terms of the dollar revenue, we're working with a growth of around 2.6%, a rupee revenue growth of 2.8%. EBIT is expected to remain flat year on year at around 19.7% mark. And the profit as well might see a slight bit of dip. Now, in terms of the reasons for the same, well, in terms of the revenue growth, that is expected to come from the IBM IP partnership that they did off late. And also, of course, this is the first quarter of consolidation of urban fulfillment acquisition that they did last year. So in terms of the split, we are working with organic growth of 1.5 to 2% and another % to be added by the inorganic moves of the company. Now, the infrastructure business, which is the mainstay of the company, has been underperforming a bit for a couple of quarters. The commentary came in from the management that Q1 FY19 will be the time that we see a bit of recovery. So that might still be a bit slow this quarter. Remember, Q2 was also hit because of India operations, and that is also expected to stay in Q3, Q4. So India business will be a bit of pain point. Other than that, there will be some benefits coming in from the IP deals in terms of the margins, but that will be offset because of the wage hike that they had taken. The partial impact of that will come through. Also, there is a headwind of around 10 basis points as far as the currency is concerned, the analysts say. Remember, depreciation and amortization was of key interest last quarter, given the fact that it had jumped up 65%, telling you that they had taken a lot of amortization, so that should be in focus as well. Lastly, just watch out for the guidance. It is expected that they're going to maintain their guidance with 10.5 to 12.5% constant currency growth for FY18 and a margin picture of 19.5 to 20.5. It is largely expected that the guidance will be met. So let's see if there's any revision to that at all.
Okay, all right, Anisha, thanks so much for that. Well, on that note, I think we can hop across to Naveen. He's standing by. He's going to tell us what to expect from big boy Reliance Industries. Hi, Naveen. Good morning.
Good morning, Nigel. We are expecting a steady quarter, but remember, quarter 3 will be quite important for IRL in terms of the numbers. Why? The key reason that, remember, the stock is at its all-time highs. On the other hand, crude, that has moved up close to 60% in the last 1 year at around $70 per barrel. Apart from this, remember, Mr. Mukesh Ambani also in his December 1st address has told us that Jio, which is his baby, that is moving towards profitability. In fact, in last quarter, the company posted a EBITDA profit of close to 1,400 crore. So that gains a lot of prominence. In terms of the overall numbers, talking about quarter 3, standalone numbers, the most important number to watch out for is the GRMs. So we are expecting a GRM of, that is a gross refining margin of almost $11.6 per barrel versus $12 per barrel. Also remember, this comes in a back of the Singapore GRMs, that is a benchmark. That is at around 7.3 barrels. So we are getting an upside of almost $4. That is what Reliance has been able to maintain for the last 3 to 4 quarters, if you were to say. On the other hand, on the basis of the consolidated numbers, at the PAT level, we are expecting, that is Kotak is expecting a PAT of close to 8,700 crore. Meanwhile, Morgan Stanley is expecting a PAT of around 8,450 crore at the consolidated level. Now, talking about segments, remember the key segment, as I already pointed out, in terms of the refining segment, the gross refining margin, that is expected to come in at around $11.6. Also in the upstream segment, which is rather insignificant right now, but gains prominence given the fact that both realizations on the gas as well as the crude, that has been surging. So that will come in as a positive for the company. The other big segment, that is the petchem margins over there, although the spreads have reduced, but on the other hand, realizations reduction was offset by a higher volumes. Jio is also expected to post a EBITDA profit. So in terms of the numbers, we are expecting a steady quarter.
Okay, Naveen, thank you so much for that. But we are not done with earnings, with discussing earnings just yet. We'll slip into a short break, but when we get back,
Okay, let's get you more earnings then that we're expecting today. From the banking space, HDFC Bank will be reporting its third quarter numbers today. Abhishek's with us to run us through a quick preview. Hi Abhishek, good morning.
Good morning, Nigel. So loan growth about 20% will be very positive. Remember, in the last 3 quarters, the loan growth for HDFC Bank has picked up at 20% plus. So that momentum should continue. Domestic loan growth about 23% will be very positive. Now, in that, the corporate portfolio has been driving the loan growth in last 2 quarters, and the corporate portfolio now forms around 46.5%. So that growth momentum should continue as they take market share from the PSU banks. Margins, the net interest margin above 4.2% will be very positive. Last quarter, it was at 4.3%. Now, the low-cost deposit share, that is the CASA ratio, was at 43%. So, sustaining that will be very positive. Anything that they mention on capital raising will be seen very closely, whether, when they look to raise capital as they had announced in December. Our polls suggest an NII growth of 23% while net profit to grow at close to 20%. Back to you.
Okay, Abhishek, thank you so much for telling us the expectations from HDFC Bank, but also tell us what to expect from Kotak Mahindra Bank today.
Well, Anisha, Street is anticipating the highest ever NII growth for Kotak Mahindra Bank in the last few quarters. That is about close to 19.5%. Now, net interest margin above 4.3% will be very positive. Last quarter, it was at 4.33%. The loan growth should sustain about 20%. Last quarter, it was at all-time high at 21%. Now, retail has been a great driver for loan growth in Kotak Mahindra Bank. And last quarter, we saw CV sales pick up. So, Kotak Mahindra Bank is also one of the great financiers in CV space. So the loan growth momentum according to analysts, is expected to remain strong. The low-cost deposits should remain strong for the bank. Last quarter, the CASA ratio was close to 48%. Gross NPA below 2.6% will be very positive. Last quarter, it was at 2.47. So our polls suggest an NII growth of 19.5%, while net profit to grow at 21%. Back to you.
Okay, all right, Abhishek, thanks so much for joining in and giving us those expectations. Well, on that note, we'll slip into a short break. You come back, we'll get you all the cues coming in from the derivatives market.
The Council has taken forward several issues, except that return simplification, that has now been pushed to the next meeting.
श्री नंदन नीलेकनी ने एक डिटेल प्रेजेंटेशन काउंसिल को दिया कि उसमें से जो बेस्ट पॉसिबल ऑप्शन है काउंसिल उसमें से ले.
As finance minister, I thought that was a really good presentation. It was workable.
You are now seeing a situation where the compensation need is in the range of 8 to 10,000 crores.
35,000 crore of fund will be settled with the states and the center.
RCM को लेके रिवर्स चार्ज मैकेनिज्म को लेके काफी चिंता थी व्यापारियों की, तो वो अब कंपोजिट डीलर्स पे ही लगेगा.
It'll go down to maybe a single return. You can call it a single return or whatever it is. If the intention is to simplify the existing processes, it is a very welcome development.
Overall, I guess some movement forward, but again, a lot needs to be done. And I think that's the story of every GST Council meeting.
This new item on the agenda, namely anti-evasion measures, I think to me this is definitional.
Well, let's head across to Manisha Gupta, who's standing by to get us all the updates from the world of commodities. Good morning, Manisha. Tell us what is happening in the world of crude and metals today.
Well, thank you so much for that. Crude prices to start with are tackling with lots of fundamentals. You have the Venezuela output, which has declined to the lowest in 28 years. You have the U.S. crude inventories, which have declined more than what the markets were working with, and the decline has come in for the 9th straight week here. So these are a couple of factors which are supportive. On the other side, the U.S. shale output has increased. The OPEC's monthly report shows or suggests that going forward, the non-OPEC supplies will continue to rise. So you have a pair of contradicting fundamentals, and that is the reason the crude oil prices have not been able to cross $70 on the higher side yet again. We did see some profit taking in the New York session yesterday, and Asia actually has opened quite on a mixed note. That's exactly the case that you have seen for the metals as a space as well. Yesterday, you saw China's manufacturing data, home sales data, GDP numbers all coming on the positive side. But even then, you didn't see a runaway rally for many of these metal prices. While we did see a 2 to 3% of gains yesterday, the metals as a space has not been able to hold on to that. Markets would watch out for the U.S. spending. There is a threat of shutdown, which usually doesn't happen because the U.S. Parliament, of course, would come into the rescue for that. But ahead of that, we have seen some choppiness come in for the Asian markets. So much would depend on the currency space on how that performs, and that would give you a reaction for this asset class.
Okay, all right, Manisha, thanks so much for joining in and running us through all those details. Well, let's hop across. Mangalam is standing by. He's going to run us through all the cues from the derivatives market. Well, Mangalam, it's a Friday. Next Friday, we're going to be on our way to Jaipur for Anisha's wedding as well. So, looking forward.
That's the future, and we have no option for that. I'll tell you what.
Absolutely.
As far as the cues for today are there, yesterday we saw a decline from the high point of the day. Mid-caps sold off, but the FIs, they went shopping because large caps were doing well. So we saw purchase in cash markets, index futures, as well as stock futures too. But the index futures purchase looks like ahead of expiry. It is in the Feb futures because the Feb open interest was up by 25%, while the Nifty Jan futures, that one saw no change in the open interest. In fact, the Nifty futures premium that we keep talking about, that turned into a discount of about 6 points. So the purchase looked like it was in the next series. And in the index options too, a large part of that was muddled because of the Nifty Bank weekly options expiry. But if you take a look at individual strikes, the 10,800 put, bulls believe they can defend that mark. Nearly 21 lakh shares added on the short side in that 10,800 put. But the bears believe that 10,900, we're taking this because the 10,900 call also added about 16 lakh shares on the short side. Watch out for a couple of stocks that enter the F&O ban. DLF is the one. Ones that exit are the likes of Capital First and the likes.
Okay, Mangalam, thank you so much for that. But with that, it is curtains down on Power Breakfast. From the team and myself, thank you so much for watching. Bazaar Morning Call comes up next.